I'm Kevin Degnan, Global Head of Structured Finance and Covered Bond Ratings at Fitch. Each year, our analysts and relationship managers conduct hundreds of one-on-one investor meetings, answering questions on a range of topics from specific transaction performance to regulatory issues to ways that we can enhance our research projects. Unfortunately, we can't visit all investors, but we can provide market participants with insight into the types of questions investors are asking us and how our analysts are responding. With that in mind, in this new series of videos, I'll be talking with the heads of our various U.S. structured finance rating groups to find out what hot topics are currently on investors' minds and how Fitch is responding to their inquiries. With me today is Huxley Somerville. Huxley is a managing director and heads our U.S. CMBS group. Good afternoon, Huxley.
Afternoon.
It seems like every investor inquiry seems to start with the question of where we are relative to previous cycles. How do you answer that question when investors inquire on that topic?
We feel it's similar to 2006, and I think most investors would agree with us. Underwriting has declined over the last 3 years. We're seeing aggressive debt levels. That being said, I think there's probably two differences to 2014 compared to 2006. The first is we're seeing credit enhancement increase as underwriting declines. And secondly, we're nowhere near the top of the potential economic cycle like we were in 2006. So as long as underwriting remains prudent, we believe that the term risk of the loans should be fairly stable.
While we might not be back at peak levels, you and your team have been very vocal about the decline in credit quality in the CMBS sector. Give us a little bit of insight into your discussions with investors on that topic.
Certainly. Underwriting has definitely declined. For the last 3 years, it's declined quite substantially. In fact, LTVs probably shows the most potential decline. In this quarter, it's over 105%, whereas back in 2012, it averaged 97%. We're also seeing a significant increase in IO loans. In 2012, they were 33%. At the end of last year, they averaged 51% of the transactions. And so far this quarter, we've seen transactions over 60% IO, which is, we've said this several times before, in a low interest rate environment, IO does not need to be so prevalent.
So that change in credit quality sort of begs the question, well, what are we doing about it in terms of the analysis of the transactions that we're rating?
Well, I already mentioned credit enhancement has increased. First quarter this year, its AAA credit enhancement is 22.875%. That's over 100 basis points over the average last year, and it's 212 basis points higher than the average in 2012. So I expect that credit enhancement will continue to increase if underwriting declines. And we often say to investors that if we're not rating a transaction, in conduits it's a little less black and white than single borrower. But in conduits, if we're not rating a transaction, we encourage investors to call us because we may have some insight to a certain loan or a certain originator. Why we're not rating it, we can give some information to the investor.
Okay. And it seems like with credit quality, sometimes it seems a bit of doom and gloom across the market. Is it all bad news, or are there differences among originators in terms of underwriting quality and people sort of holding the line?
Well, we've just written a report, Originators Do Matter, and in that report we have analyzed various property and loan metrics and compare originators against one another. Now, this report is not meant to be a measurement today, it's more what is the trend over time? Where do originators go with their underwriting standards going forward? But I think it's fair to say that already you see some originators who are perhaps more prudent than others.
Let's move on to property types for a moment and talk to us a little bit about where your concerns are in terms of the variety of different property types that we see in the transactions that we're looking at.
So malls are still probably the number one concern. Not so much the top end and not so much the bottom end. It's the middle tier malls are very hard to determine which ones are going to be successful in 10 years still, given internet competition, demographic changes, and potential for weak anchors to disappear. And then perhaps counterintuitively, the property types that bounced back the quickest after the recession, multifamily and hotels, we're also taking a very close look at. They are actually performing better than they did pre-crisis, We're starting to see more construction, more lending on those properties. So we're just watching those very carefully. And of course, the properties that are in the cities that were affected most by the single-family housing declines, Atlanta and Phoenix, we look at very closely.
Thanks, Huxley. As we wrap up, why don't you give us a bit of your outlook for the U.S. CMBS market for the remainder of the year?
Continued robust issuance on multi-borrower and large loans. Pressure on underwriting, but if Fitch is rating the transaction, then increased credit enhancement. And we expect to see more floating rate large loan transactions where there is a repositioning of the properties.
Terrific. Well, thank you very much for sharing your insight into your investor discussions. If you have any additional questions or for more information on the research Huxley spoke about, contact us at the email address on your screen. Thanks for watching.